You're about to hear my conversation with Lesley Marks, Chief Investment Officer of Equities at Mackenzie Investments. We'll talk about Mackenzie's 2026 second half market outlook, including value versus growth, earnings outlooks for Canada and the US, hyperscaler valuations, the Fed outlook, and talk about regions and sectors that Lesley likes for the second half of 2026. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to the Invested podcast from Mackenzie Investments. My name is Dustin Reed, I'm Chief Fixed Income Strategist here at Mackenzie. Today, I'm joined by Lesley Marks, our Chief Investment Officer for Equities, to discuss Mackenzie's mid-year 2026 market outlook. Welcome, Lesley. I look forward to our chat today.
Great to be here with you, Dustin. I feel like we've got it covered off between equities and fixed income here today.
Yeah, absolutely. Looking forward to our discussion on a few different topics. Love to get your thoughts on earnings estimates for the back half of 2026 and for 2027. Obviously, they've been pretty frothy from a consensus perspective, at least in the US. How do you see the earnings consensus numbers lining up versus your expectations for Canada and US for the rest of this year and into 2027?
Well, I think it's really a timely question and a great place to start, Dustin, because we are just in the early phases of Q2 earnings season. And overall, the metrics have been actually quite positive, a high percentage of beats on both revenue and earnings. So it looks pretty healthy out there on the earnings front. But of course, that's backwards looking. I think what's most notable for our listeners is that stocks are not really responding that positively to these beats. And that tells me, or that's a sign that there is some concern about the outlook for earnings into the future. Both US and Canadian earnings estimates, coincidentally, this year are estimated to be around 30% growth. And that's actually doubled from the beginning of this year. You know, when we wrote our outlook for 2026, we had expected kind of 14 to 15% growth in earnings. In both cases, that growth is pretty back end loaded towards the second half of this year. And it comes from different places. You know, the US is much more broad, but primarily technology and AI related, either sort of first order or second derivative AI beneficiaries contributing to gains, but also gains on equity investments, which are really unpredictable and rely on strong equity markets. In Canada, of course, the earnings growth is not coming from the strength in the Canadian economy. You would know that better than anyone. It's really from the resource sectors, and it's been supported by stronger commodity prices. So the stronger commodity prices have translated into higher earnings. When you look at energy, 17% of the TSX, materials 15%. Commodity prices are generally higher year over year, but they are down from their peak. So to get directly to your question, this will make things a little more challenging in the back half of this year to sustain the growth expectations. So I think overall, it's going to be a great year for earnings this year, but it's so much about expectations. And I think we're sort of at the peak of expectations, and it's hard to see any revisions higher from current levels. And 2027, the expectations are for about 15% growth, which is still a very strong earnings growth year. But remember, that will be comping on a very strong year in 2026. So I think those numbers could look a little bit high as we head closer towards the end of this year. We may see those expectations start to come down.
Yeah, for sure. The sequential big year over big year expectations, I think, are really important here in terms of just overall risk sentiment and equities as they trade for the next 6 to 12 months for sure. Maybe on that theme, last year for sure, earlier this year, absolutely, growth versus value. And obviously everyone knows the Mag 7 hyperscaler story, but how do you see the growth versus value play and thematic coming together for the back half of 26 and into 27, given what we had for the first half of 26?
Yeah, so we have to be really careful in the bifurcation of growth versus value because once you start separating benchmarks, names actually shift around. Google can be a growth name at a certain point in time, and then it can become a value name in a quarterly rebalance. So it's been really interesting to watch the growth versus value trading behavior. Now, having said that, I think where you're sort of implying towards is that it's been a very strong year for value indices overall. If you look at the Russell 1000, it's up 21% year to date. And the Russell 1000 growth, this may surprise some people, is down 1.3%. The same trend can be seen with the MSCI World, up 14% year to date. MSCI World growth is only up 5%. So, same trend, but less of a differential. So I want to frame my answer more in the context of sectors and the undercurrents. Obviously, resources and banks are, typically quite dominant in the value indices, and they've done really well this year, and they're a big part of the value trade. The other thing that's been driving the value trade is what I would call the more cyclical technology names, things like the semiconductors, semi capital equipment. They've also done really well, and they've been the momentum trade of 2026. So we already talked a little bit about some of the commodity stocks losing some of their earnings momentum because of lower prices. Financials have really been driven by many fundamental factors. Strong equity markets, obviously helping the wealth management side of the financials or the banks, strong IPO market, capital markets trading, equity underwriting, all of that really great for the banking sector. But if we see any sort of softness in equity markets, we could see that momentum or that earnings driver start to peak out as well. So there are a couple of pretty significant headwinds for value to outperform to the extent that it has in the first half of this year into the second half of this year. So what I think we're set up for is a little bit more of a balanced picture between value and growth. And at this point, I wouldn't be making a big call towards one over the other because of what has been driving the value sector and its outperformance year to date.
Oh, that's great. That's a really important outlook, I think, in terms of kind of the sectoral or thematic growth versus value and looking at it from that perspective. I think that's extremely important for investors, especially when you look at kind of asset allocation type decisions, maybe within all the things that we've talked about so far, including the earnings side and growth versus value. Obviously, hyperscalers have been a huge story. Everyone pays attention to it. It's obviously been a big driver in 25 and 26 and will continue to be a driver, I think, in either direction as it goes. But in terms of the multiples and the value that are in the big hyperscaler names here at the moment, do you see value still in those names, or is it time to expect a little bit of flattening out of that price momentum?
Well, it's interesting, if you connect this question to your previous question. I mean, some of these names are becoming the value names, like whether it's Google or Microsoft or whatnot. So, when you think about the value versus growth dichotomy, you have to sort of change the mindset a little bit. To the fundamentals, the market is really starting to question the sustainability of the CapEx cycle. And, better than anyone in the credit space that investors do not, whether they're equity investors or bond investors, they don't like the depletion of free cash flow from CapEx. Obviously, these companies have gone from being huge free cash flow providers to almost, in some cases, negative free cash flow because of the CapEx. And we continue to hear them talk about increasing CapEx. And I know you and I yesterday were looking at the increase in CapEx estimates for this year and next year, hyperscalers, even versus what we saw, 6 months ago, is unbelievable. It's 30 to 40% higher than, where we started at the beginning of this year. I also think what's getting a lot more attention is when you see companies like Nvidia, which we saw in the news yesterday in the Wall Street Journal. There was a story about Nvidia in negotiations to backstop a financing for OpenAI. These are things that make people, more concerned. I mean, obviously, Nvidia has an interest in backstopping these financings because it creates more demand for Nvidia. So I think that even though valuations have become a lot more attractive, I think we have a little bit of time on the hyperscalers and a better opportunity may present itself yet. Now, I'd love to turn this question back to you because you're very close to the credit cycle. You've seen the demand for AI linked bonds, and it's obviously been decreasing steadily. Yesterday, there was a news story on Bloomberg, for example, around the demand for issuance that has been historically over the last year or so outstripping supply. But BlackRock did an issue for Meta's data center, and demand actually appeared to be quite weak. So I'd love to hear also from you what you're seeing in the credit markets in the space.
Yeah, it's certainly come off a little bit from kind of the peak euphoria, as it were, a few months ago or a few quarters ago. We've had Google, I guess Alphabet issue, Amazon's issued, Meta has issued, and some of those have been Canadian issues as part of an overall issue. So we're seeing a little bit of money come in domestically on the Canadian side, which is interesting. And just anecdotally, I've heard that some of that Canadian raise in Canadian dollars for the bonds haven't necessarily been flipped or put back into US dollars, which seem to suggest that there might be some hyperscaler spending by the big names in Canada. We've already seen some of that. What I think on the credit side, the euphoria is past. And to your point a few minutes ago, that cash flow concern is becoming a bit problematic. And investors are concerned. You can see it obviously in the names and the price movement or non movement, as it were, in equities and how it's feeding overall. I think there's still relatively decent demand for paper. It just might take slightly wider yields or slightly more premium on the credit side to actually get those orders filled in the size that they're doing. And they're obviously quite sizable. I think it's interesting. And, you and I talked about it yesterday for our global investment committee, but the economy and markets are obviously related. But as I like to say, the economy is not the market and the market is not necessarily the economy. And so there's the idea around the point you just made a couple minutes ago around the CapEx spend for the economy being a significant number. I think you and I were talking about 900 billion for the US yesterday over a denominator of, I think, maybe 630 billion for this year. So 630 ish for 26 and then expected to go to 900 for 2027. So that's pretty significant move. And to your point, a few months ago, 3, 4, 5 months ago, maybe 6, those numbers were a lot smaller, and the sequential 26 over 27 wasn't as big. And that's really powering the economy. But investors are getting a little bit concerned about, I think, valuation long in the tooth, and then the credit side as well. This is becoming a bit of an issue, and you can see it in the prices. So I'm not expecting a complete disaster in hyperscaler credit market, but these spreads are probably going to need to be a little bit wider over treasuries, let's say, or Canadian government bonds, just to make it more appetizing for investors to come in on the debt side.
And are you seeing any strain in the CDS market for some of these companies?
Certainly moving higher over the last few weeks, let's say. I wouldn't put it at strain territory yet, but the CDS market for a lot of the hyperscalers has certainly curled higher in the last couple of weeks. So we are seeing that concern. And then you would obviously expect the premium in terms of issuance to be a little bit wider as well. So you kind of see that go hand in hand, which is, likely the case, I think, for the next little while, unless the market thematic turns, which I don't particularly expect it to turn anytime soon in terms of appetite for issuance and that sort of thing. On the interest rate side, since we're here, I mean, rates, and I'm a little bit biased, I'll admit, but, I think that rates are very important for the economy. The Fed and central banks are very important for all asset classes, not only fixed income, but, all asset classes, valuations, et cetera. Are you watching, or how are you watching expectations around the Fed through the rest of the year and into early 27 in terms of how it could impact equities from kind of a top-down overall index valuation?
Well, I think the Fed outlook is very important for equities. As our listeners know, stocks trade on earnings valuation and sentiment, and a more hawkish Fed or rising interest rates does impact what people are willing to pay for equities. Mea culpa on our part. The expectation of a dovish Fed was part of our bullish thesis going into 2026 for equities. And that hasn't played out as we've seen. The Fed now has reason to be more hawkish with the inflationary trends. Now, to give us a little bit of credit, I don't think we anticipated that we'd be in this situation with a war in Iran and the impact that that would have on oil prices. And that's been a big part of the narrative impacting inflation. I think also with new Fed Chair Warsh, as you and I also talked about yesterday, with less forward guidance, the market is guessing more on the Fed's next move. And I think that in itself creates more volatility for risk assets. And, people, they don't like surprises. So I think people have gotten very comfortable with knowing what to expect each Fed meeting. And I think we're having to get comfortable with being uncomfortable a little bit here. The other thing I would also note about the Fed is that the Fed hiking also reinforces the divergence with the Bank of Canada, which is going to have trouble hiking in the face of the weak Canadian economy, which you know as well as anyone. And that's going to also hold our dollar down, but that's probably actually good for TSX earnings. So marginally better for Canada and Canadian stocks. But I want to turn this question back to you because we happen to be recording on the day that we're going to get a Fed decision. So I'm not going to ask you for a prediction, Dustin, but I'm going to ask you what you think the Fed should do here. So, Dustin, what should the Fed do here based on all of the data that you're looking at every day?
I think the Fed should and will for central banks are always kind of the key question when you're looking at central banks and macro, top-down macro. If it's, Dustin, what should the Fed be doing? I mean, I think the current rate for Fed funds, which is 3.5 to 3.75, is probably 50 to 100 basis points below where rates probably should be from where is neutral for the economy. So right now, rates that the Fed is administering, Fed funds, is quite accommodative, and that probably needs to move higher. And I would argue that I would have said, similar-ish in February before things really got going in the Middle East. And the Middle East and oil prices higher and commodity complex higher, energy prices higher has only served to kind of reinforce that. So I would say that range has gone from kind of 50-ish to maybe 50 to 100. So I think the Fed should be, if it's a should, what does Dustin think that the Fed should be doing if he was there? Fed should be hiking rates because inflation is not going to come back to 2% at these levels, and they're not high enough to slow aggregate demand. So I think we will, whether it's today or not, I think we will see a more hawkish Fed throughout the back half of 2026 as they adjust to get the short end rate and policy rate higher going forward. Maybe last question to finish it off. This has been a really great chat. Just if we kind of boiled it down to key either sectors or regions that equity investors and all investors want to look at that you like, Lesley, for the back half of 26 and into early 27, are there key sectors either in Canada or the US or regions maybe outside of Canada or the US that you think are particularly interesting and attractive here or areas you want to avoid?
Well, I think it's hard to say where the best opportunities will be in the second half because we could see a continued reversal of some of the momentum trades that have existed in the first half. And if that's the case, I would say sectors become more important within a region because certain sectors have really been driving that momentum in a region. Like if you look at in Japan or South Korea, I mean, these have been top performing markets. So we want to be really careful about where we invest within a market as opposed to just investing in a market sort of blindly. And I think as we experience this rotation, which may be temporary, this may be a 6-month phenomenon, you'd want to look at diversifying into some of the sectors that have actually been underperformers so far. And those would be, more defensive names, consumer staples, utilities. I think the defense sector continues to play an important role in every economy as global economies look at spending more on defense. I think commodities still play an important role as a diversifier for your portfolio. I mean, we're in a very unpredictable geopolitical risk time. I think those companies that have been perceived as AI losers over AI winners, I think the dust could settle and these things have been, very much oversold on the expectation that fundamentals are declining at a much faster rate than they probably will in the real world. So I think you start to look at some of those attractively valued companies that have been sort of, left ignored or sold indiscriminately. So I'd be very careful around just blindly going into markets without having a sense of what exactly you're buying in those markets, but keep that diversification up, have exposure to international, not just the US, which is very technology heavy, in Canada, as we know, commodities, banks, big drivers of our market. There could be a soft patch here, but there's a lot of attractive opportunity still here in Canada in certain sectors.
Yeah, absolutely. No, that's fantastic. I think that's very, very well said in terms of continuing the diversification ahead of what's going to clearly be a very interesting and probably slightly higher volatile environment in the second half of 26 and maybe even into early 2027. Well, I want to thank you, Lesley, for your time this morning. This has been a really great conversation. I've really enjoyed it. Really enjoyed covering for my colleague Rajan, who's normally here on the Invested podcast. Wish you a great day and a great summer, and our investors a great day and a great summer. Thanks for joining Mackenzie Investments, the Invested podcast, and we'll see you next time.
Thank you, Dustin.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.